Okay, so last time we were talking about options. Can anyone tell me what does a call option give you the right but not the obligation to do? Yeah, buy something. And in our case, it's a share of stock. Okay, now, the thing that we're going to talk about here is the put option. And everything's exactly the same in that language, except the change of the word buy to sell. So if you buy a call option, you're basically betting. You're like buying a lottery ticket and hoping that the stock price goes up. If you buy a put option, you are hoping that the stock price will go down, right? So if you think a stock is about to tank, Mr. Merz tells me I should have probably bought some put options on a couple of companies that I mentioned in our discussions because their stock prices went, right? And so I could have made some really good money there. Okay, so that's what we're doing here is we're betting against a stock. Now, there's another way to bet against a stock. It's called a short sale. And that's where you borrow the shares from someone else and then sell them, hoping to buy them back later at a lower cost. I don't recommend to any of you that you get into short selling. If you want to bet against the stock falling, which I'm not recommending, but if you do, this is the way to go about it. And so when we exercise a put, it means that you're forcing the person that wrote that put option, the writer or seller, you're forcing them to buy that stock at the exercise price. And that exercise price is going to be greater than the current stock price. And we'll see why that is here just in a second. So let's talk about put option pricing at expiry. Once again, or expiry, as Mr. Ali says. Once again, we have, it's basically on the last day, an American put option and a European put option are exactly the same. And so we can value them using this formula by P. By the way, P stands for put, right? So this is the premium on a put option. It's equal to the maximum of either exercise minus stock price or zero. How does that formula differ than what we saw for call options? Yeah, it's just backwards, right? And so this thing is going to have a positive value when the exercise price is higher than the stock price. And that makes perfect sense because let's say that you have sold me a put option with a strike price of $30, exercise price of $30. Now the stock is down to $25. I am forcing you to buy that stock for $30, and then I could just turn around and buy it for $25, right? So it'd be a $5 profit. And so that's why the formula is this way. And so as long as the exercise price is greater than the stock price, then this thing has a positive value. However, what happens when the exercise price is lower than the stock price? What happens to that E minus S of T? It becomes negative. And then when I do this whole maximum of a number, negative number or zero, which is going to be the maximum? Yeah, it's going to be zero. And then what if they're exactly the same? It's still going to be zero, right? It'll be the maximum of zero or zero, which we know is zero. Okay, any questions so far? Okay. Now let's look at the option, the payoff to a put option. And once again, this is the payoff to the holder. The payoff to the holder or buyer of the option. This is the payoff to the holder or buyer of the option. And that's why it says buy a put out there. And the way to, allergy troubles today. Okay, the way to think about this is to start from this end. That stock price can go down, 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 but the payoff is zero until we hit what? The exercise or strike price, right? And once we do that, for every dollar the stock price goes down, the put option goes up $1 in value. And it goes all the way down, and the most it will ever be worth is how much? It's the exercise price or strike price, right? Would be the most it will ever be worth. Now, How is that different than a call option? The potential the potential payoff from buying a call option is infinite, right? But we are limited in our potential gain from buying a put option because the stock can't go lower than zero. Does anyone remember why stocks can't go lower than zero? It has something to do with the law.
Limited liability.
Yeah, limited liability. Limited liability is why stocks can't go lower than zero. Okay, so those are the payoffs from buying a put option. So if you have bought one of these things, you are happier if you are below the strike price. The stock price is below the strike price. Now let's look at the profits. And once again, the profit is equal to the payoff minus the premium. Payoff minus the premium. And here once again, we've got the option premium of $10. And so now, once I subtract that premium, everything in that payoff shifts down by $10 to become the profit. And so the maximum profit on this thing would be the strike price minus the premium. The maximum profit, if I say it twice, right, probably a good idea to write it down. The maximum profit from buying a put option will be the strike price or exercise price minus the premium. Now, where's your break-even point here?
40.
Yeah, 40. So that would be strike price minus premium as well. Now, let's ask this question. If the if the stock finishes at 60 and you've got an exercise price of 50, do you exercise the option? If the stock price is 60,
No.
yeah, no, why not? Yeah, so if the stock price is 60 and I exercise the option, then I'm basically forcing you to buy the stock at 50 when what else could I have done?
Sold it for 60.
I could have sold it for 60, right? So I'd have to be insane to exercise this option anywhere above 50. Now, what about 40 and below? Do I exercise or not? Yeah, definitely so. Now let's see if you remember from last time. What about 45? Would I exercise there? Yes. Yes, why?
Because you lose less.
You lose less. Do you see that? So at 45, yeah, we're going to lose 5, but if I don't exercise, how much do I lose? 10. Right? Does that make sense? So if I don't exercise this, I've already paid that $10. It's gone. It's gone forever. If I don't exercise this option, I'm out $10. At 45, if I do exercise this option, I'm only out 5. That's hard for people to get, right? That's why I asked that question more than once. Okay, now let's talk about option value. And we'll come back to, in a minute here, I'll talk about the payoffs to the people who write the option. But let's talk first about option value. And this is relates to the question that you asked last time. So pay close attention. Here we go. Okay, so it turns out that there are two pieces of value to an option. There's the intrinsic value, which is exactly the same as the value of the option on the day of expiry or expiration. But there's also something called a speculative value. If you have any time at all left until the option expires, then there's always a chance that things will change, and people are willing to pay for that lottery ticket chance that something will change. And so the example here, we can see that the intrinsic value of a call put, we've already talked about those. If you go out and you look at an option premium, which is what the option is selling for, you can then figure out what the intrinsic value is on that day. And if you take the option premium minus the intrinsic value, it gives you the speculative value. And so assume that we have a stock and the call option premium is $3. The intrinsic value is only $2. How much is the speculative value? $1. Now, what if we see a put option that is selling for $1 and the intrinsic value is 0? Is that possible for the intrinsic value to be 0? Absolutely. If the exercise price is above the stock price, wait a minute, if the stock price is above the exercise price, then that thing's really not worth anything intrinsically. But it's still selling for $1. That dollar would be pure speculative value because there's no intrinsic value to that whatsoever. Now the question is, why would anyone spend $1 for something that has no intrinsic value? Any ideas? What are they hoping is going to happen between now and expiration? Yeah, they're hoping that stock, this is a put option, they're hoping that stock price is going to go down before expiry. And they're willing to spend money, and it's basically like buying a lottery ticket, right? And someone else is willing to sell them that lottery ticket. Does that make sense? And so we're actually going to look at some quotes, and I will show you in these quotes that the speculative value is greater than 0 on these things, if they have time left to expiry. Questions? Do people value lottery tickets? Yeah. It's the same thing here. It's the same thing on a convertible bond. It's the idea of, yeah, but what if this happened, right? So, now we've been talking all about buying options, and you would be the buyer or the holder. Now we're going to talk about selling options, and we call these people the sellers or the writers. They don't have the right but not the obligation. They only have an obligation, and that obligation is to do whatever the holder or buyer of the option wants to do within the confines of the contract, right? If they want to force me to buy it and it's a call or a put option, I have to do it. If they want to force me to sell it and it's a call option, I have to do it. So what do I get in exchange for that? I'm giving up some of my freedom or some of my rights. I have to get something in exchange. And so what I'm going to get in exchange for that is the option premium. That option premium, which is either P or C, that option premium is what I'm going to get in order for putting myself in that situation where I might have to buy or sell a stock. Questions? By the way, everything that when we deal with derivatives, all derivatives are a zero-sum game. Investing in a stock is not a zero-sum game. So I invest $20, the company goes out and buys an asset or invests it in research and development, and then they end up creating something, let's say like the iPhone, that changes the world and creates wealth. That's not a zero-sum game. When I say zero-sum game, what I mean is if the buyer makes $10, then the seller loses $10. And so when you look at the sum of the gains and losses for these, before taxes and trading costs, it's always 0. And this is true for futures contracts, options, all sorts of derivatives. They're a zero-sum game. Now, after you consider taxes and transactions costs, it's actually, the whole world is worse off for having done this, right? Because those taxes and transactions costs eat into the gains of the winner, but not the losses of the loser. Because of course transactions costs, both of them get hit with those. Okay. Now in theory, the loser can write the loss off, but only if they have a gain to outweigh it. Does that make sense? Okay. Let's see. So let's talk about what a call option payoff looks like. This is from Selling the Call Option. When I sell the call option, my payoff is 0 until I hit the strike price. And then for every dollar the stock price goes up, I lose $1. So let's talk about why this might be. So here we've got a stock price of 50 and the shares go to 60. I've lost $10 because I'm being forced to sell at 50 what I could sell for 60. Does that make sense? So that's an opportunity cost, right? I had to forego being able to sell the stock at 50 in order to get that option premium, and I'm now forced to sell it at 50. Okay, so for every dollar that the stock price goes higher, then our payoff goes down by $1. What are the potential losses from selling a call option? Infinite! Infinite! Oh my goodness. Now, has anyone ever lost infinity on one of these? No. Have they lost a boatload of money before? Absolutely. Now, let's talk about, in fact, I get to talk about naked options here in a bit, don't I? No. Okay, well, I'll go ahead and tell you about naked. So, I used to sell call options, and I sold covered calls. And if you sell covered calls, what it means is that you own the stock underlying. So, I bought a company. By the way, contracts on shares are always for 100 shares. Option contracts are always for 100 shares. And so what I did is I went out and I found a company. And it's better to find ones whose stock is volatile. We'll get to that in a little bit. And I went out and found a company, and the ticker symbol was GENE. I think they were a biotech firm of some sort, but I wasn't buying based on their underlying business. I was buying because it was a good stock for me to do this covered call strategy. Now, I had that 100 shares of stock, and every quarter I would sell covered calls. Now, it's called covered calls, once again, because I have the stock. What can I do if the other person exercises the option? I've got the stock, right? But there is another kind of selling of call options, and it's called, this is as exciting as finance gets, right here. Naked calls. What do you think a naked call is? Yeah, when you're selling call options on something you don't have. Now, you make more money selling naked calls if things go your way. But if they don't, here's the problem. I may be forced to go out and buy a stock for a boatload of money in order to get a small exercise price from the person that holds that option. That's the danger. And I will give you an example of what happened with this stock right here. I don't even know if this stock's still around. This was like 1998, 9, or in that neighborhood. This stock was selling for around $7. That's what I paid for it. So I had $700 invested in this whole thing. And I kept selling the covered calls, and I never got called out. In other words, the share price never took off. And so at some point, I'm like, you know what? I'm bored of this. I'm not making all that much money because it's only 100 shares. I decided I would sell my stock. But I thought, I still want to make a profit on it. So being a very reasonable man, I went out and put in a market order to sell at $21 per share. Now, $21 per share. I've got $7 invested. We're talking about a 200% profit because, I'm a reasonable man. I'm going to limit my expectations, right? And so I put that in, and of course it expires, and then you have to put it back in, and I just keep doing it. And then one day, I get this email from Ameritrade, and they say, your GENE stock has sold for 22. Now, I had an order in to sell at 21, but my stock sold for 22. I'm like, wow, that's great. I got $1 more than I asked for. And then I think, wait a minute. Why did I get $1 more than I asked for? And so I go out and I look at the stock quote, and the stock is up to $106. Why did I not get mine sold at 21? Because the stock was going up so fast that when they pulled the sell trigger, between the time they pulled the sell trigger and the time it actually sold, that stock had gone up $1. That's huge, right? And so there for a minute, I'm patting myself on the back. And once I check the stock price, do you think I'm happy? No, now I'm kicking myself in the butt, right? Does that make sense? Now, what if I had, so I paid $7 for the shares. If I had put in an exercise price for 10, I would have had a cost there, I would have lost $96 because instead of getting those things sold at 10, having to sell them for 10, I could have sold them for 106. Does that make sense? Now, let's ask this question. What would have happened if I had been selling naked calls?
You have to buy them at 106.
Yeah, I gotta go out there and buy it at 106 in order to sell it for 10. I'm gonna have a loss of $96 per share. Now, the loss, it's $96 either way, but with the covered call, did I have to scramble to go out and get the stock? No. Did I have to round up more cash? No. And so selling covered calls is quite safe, and it's a way to improve the returns on your portfolio. Selling naked calls is freaking crazy, and if you ever do it, give me a call and I'll set you up with a nice psychological counselor who can help you with your problem, right? Because that's just nuts. Don't do that. Questions?
What's the benefit for like the writer to call option? If they're like hoping to make their like little premium margin back, but they have potentially like unlimited
Oh,
losses,
yeah.
like why would you write a call option?
Well, so like I said, I wrote them over and over and over again on the same 100 shares and never got called out. I'm pocketing that money. Now, every single bit of that option premium was short-term capital gains, which is taxed at the highest rate, or it was at the time, but I was still coming out money ahead. That was the other reason I gave it up, is because it made my taxes messy. I hate that. You know, I wasn't making all that much money. It made my taxes messy. Okay, so that's why you do it. And by the way, if it wasn't a fair deal, so if the option price out there right now is $3, that means that the seller of the option is willing to make that gamble for $3. The buyer is willing to make that gamble at $3. So they meet. And by the way, these things are bidded up and down just like stocks, right? And so the price represents the fair market value. And we'll discuss where that fair market value comes from. Mr. Ali and I could have different opinions about where a stock was going. And I could think it's going to stay the same, and Mr. Ali could think it's going to go through the roof. I would be happy to sell him a call option. He would be happy to buy it. Does that make sense?
Betting on two different sides of the same.
Oh, yeah. Oh, and here's the only thing I can tell you for certain, that when you add my payoff and Mr. Ali's payoffs together, what did they sum to? 0, right? Okay, now I did not make a slide, a curve showing the profit from selling a call option. But we can look at it this way. The profit is, in this case, the payoff plus the premium, right? So this is for buying. And then for selling, your profit is equal to the payoff plus the premium. So what does that mean? It means, let's assume that the option premium here is $10. What would the profit be when the stock price stays at 20? Yeah, just $10. What would it be when the stock price goes to 40? $10. What would it be when the stock price goes to 50? That's still $10, right? Because they're not going to exercise that option. Now, let's ask the question, what is the break-even point for selling a call option? It's the exercise price plus the option premium. And you can see that here. If we shifted that entire curve up by $10, now that profit is going to be crossing exactly at 60. And so even if the stock price ends at 55, you would still have a $5 profit because you had the negative $5 payoff plus the $10 premium gives you a positive $5 profit. 60 is where it turns to 0, and after that it goes negative. And after the break, or actually after the exercise price, your profit drops by $1 for every dollar the stock price goes up. And so once again, since your payoff is theoretically negative infinity, what's your profit theoretically? Theoretically, negative infinity is your worst possible payout, right? Or your worst possible profit. If your worst possible payoff for doing this is negative infinity, right? So what's negative infinity plus $10? Basically negative infinity, right? By the way, which is more, half infinity or infinity? Yeah, they're both the same, right? Isn't that freaky? Okay. Any questions? Okay, now let's look at put option payoffs. And remember that the payoffs to an option or from selling the option are exactly the opposite from buying it. And we know that the put option payoff for buying it was positive below the exercise price. And so it doesn't surprise us to see that the payoff from selling a put option is negative below the exercise price. Only this time, our payoff from selling the option has a limit. The most you'll ever lose on this situation is how much? Not the premium. Well, we'll get to, sorry, we're talking about payoffs right now. We'll get to profit. Yeah, so right now, the worst possible payoff you're going to have is minus exercise price. The worst possible payoff you're going to have is minus exercise price because that's the most you could lose. And how does that happen? Let's assume the stock goes to 0. If the stock goes to 0 and the person with the put option exercises the option, you're now forced to buy something worthless for the exercise price. Therefore, your worst possible payoff is negative exercise price. Now, let's talk about profit. If I'm selling the option, I receive the premium, so that's why the profit to selling is payoff plus premium. I'm going to have to shift everything up $10. What is the most I will ever lose profit-wise? It's going to be the exercise price minus the premium, right? Because you're getting that $10. That's yours to keep. The most you could ever lose payoff-wise would be 50, and so the most you would ever lose profit-wise would be how much? What did it say?
60 altogether, or 10?
40.
40, sorry.
That's okay. So keep in mind, I received that 10. That's positive. That's why on this side, we're saying it's payoff plus the premium, right? Because we received that money. It's ours to keep regardless of what happens. But I have to deal with whatever payoff this thing throws at me. And this thing is throwing me negative payoffs below the exercise price. And the worst payoff I could possibly have would be negative exercise price. And so the worst profit you could ever have would be negative exercise price plus the premium. Questions? By the way, is this stuff easy to comprehend? Oh no, it takes a while to wrap your brain around it. Do you think I used to be able to think so clearly about these things? Absolutely not. The first time that I taught this material, it was a total mess. Now it's only a partial mess because I've been doing it long enough, right? So my point to you is this: how easy is this material for you to learn? It's pretty difficult, isn't it? What does that mean for how much you're going to have to put into this to understand it? More than your usual amount of effort. I'm sorry to tell you that. Questions?
Selling a call option from seller's point of view, you know the company is going down, but people thinking it's going to go up. That's how you make money.
Yeah.
On the selling a put option
Well,
would
and
be
it's not no, it's expect. Right?
expect. Yeah, selling a put option would be people think that company is going down,
Uh-huh.
but I think it's going up.
Or staying the same.
Stay same. That's how I make money
Yeah.
with the premium. But on here, stock price is going up.
Okay, so keep in
And
mind
Suda
that
is just so confused right
this
now.
is the, oh yeah,
Yeah.
this is the selling side.
Uh-huh,
If I sell a put option,
uh-huh.
where does it start to hurt for me? When the stock price is below the exercise price. If I sold a call option, when does it start to hurt for me?
Goes up.
Yeah, when the stock price is above the exercise price. So if I sell a call option, I'm hoping that stock stays the same or goes down. If I sell a put option, I'm hoping that price that stays the same or goes up. Right?
So if it goes up, I get to keep the premium. If it goes down, whatever the price plus premium would be my loss.
So any time, and I'm going to make this a general statement between the two, any time that they don't exercise, so you're the seller,
Mhm.
any time that the holder doesn't exercise, your profit is equal to the premium because their payoff is zero, right? So your payoff is negative zero, and so that means you get to keep the premium. But when on a put option, when it starts to get below that strike price, then for every dollar it drops below the strike price, you lose another dollar. And the opposite way is true on a call option. That every dollar the stock price goes above the exercise price, you're going to lose another dollar as the writer of the option. Oh yeah, it's not easy. Go ahead.
So the payoff and premium versus. Okay, got it. I
Yeah, so, and the trick is to remember, and read carefully on exams. Do you think it's possible that I would ask you for the payoff?
No.
Yeah. Do you think it's possible I would ask you for the profit?
No.
Yes. If I ask for the payoff and you give me the profit, by the way, do you think that would probably be another one of the choices? Sure. And if I ask for the profit and you give me the payoff, by the way, do you think that would be one of the other choices? Sure.
So when you said like worst payoff, you're asking the payoff, not the profit.
So for this one, the worst payoff for the seller is negative 50. The worst profit would be minus 50 plus 10. Yeah, I think you got it. Okay, now, some of you are looking very comfortable, like you've got it. And some of you are like, chapter 17 only covers 1/5 of exam 3, so there'll only be 8 questions, only 4 calculations. 4 calculations out of 40, that's 10%. Am I happy getting the B? Why not, right? And whatever it is you want out of this life, that's not for me to judge. You need to decide. But if you want the A on this exam, what are you going to have to do? Learn how to do this stuff. Questions? Okay, now let's look at how options are quoted. Now, I'm going to say it again, and some of you will undoubtedly forget it, but here goes. Every time you see this stuff, we have to multiply the prices by 100 because every option contract is for 100 shares. And it's a rookie mistake, and I almost made it myself. I went out and I'm like, well, hey, I've got this 100 shares, and so I go out to buy 100 options. If I had pushed the button on that, I would have had how many shares under contract? 100 contracts times 100 shares is what, 10,000? Oh man, I would have been in a world of hurt, especially if that thing didn't go my way. Does that make sense? Okay, so that's the first thing to keep in mind. Everything we're doing here, so for instance, we're going to go out and buy a call here, the 138 and a quarter is 19 and a half, or no, sorry, the 130 October. If we're going to go out and buy that, it's 15 and a quarter. Am I going to spend $15.25? No, how much am I going to spend? Can you take $15.25 times 100? It's $1,525, right? Does that make sense? So, always be careful, because you can end up with spending a whole lot of money and not even realize it when you go out to buy options. Okay, now let's see how this is set up. First of all, the quote is always for one company. And notice that all these numbers below it are the current stock price. That's going to be the same all the way down that column. They really only need to put that up there once, right? Because it's the same for everything. The stock price today is the stock price today. Now let's look at strike prices. We have strike prices, and we've got more than 130. We've got more than 130, more than one 130. We've got more than one 135, and we've got more than one 140. And the reason why we have more than one of each of those is because they have different expiration dates. That first one expires in October, the second one in January, the third one in July, the fourth one in August. Now, why do we have two Julys up there? Because one of them has a 135 strike price and one of them has a 140 strike price. Does that make sense? Okay, now let's look at these and see if we can figure out the speculative value on each of them. If I have a let's look at the one that they've marked up big time there. So if I've got a July 135 call option that I have purchased, what's the intrinsic value of that? The value of the intrinsic value is going to be the maximum of strike price minus exercise or zero. Or stock price minus exercise. What is the stock price here? 138 and a quarter. What's the exercise price? 135. What's 138 and a quarter minus 135? $3.25. Now, I want you to notice over here that the last call that sold there was 4 3/4. We just got through saying that the intrinsic value of this thing was $3.25. Yet it's selling for $4.75. What does that tell us about the intrinsic value? Yeah, it's $1.50, right? We're going to take that $4.75 minus the $3.25 and come up with an intrinsic value of $1.50? Okay, now let's look at the put option. What's the intrinsic value of the put option? It's the maximum of the exercise price minus the stock price or zero. The strike or the exercise price here is 135. The stock price is 138 and a quarter. So if I take 135 minus 138 and a quarter, that's minus 3.25. What's the maximum of minus 3.25 or zero? Zero. Yet this thing's selling for 13/16. How much is the intrinsic value, or is the speculative value of this thing? That's got to be 13/16, right? It's purely speculative value here. There is no intrinsic value at all. Yet people are still willing to pay money for that option. Why? They're holding out hope that something will happen. If you buy a put option, what are you hoping will happen? Yeah, you're hoping that the stock price will go down. And they're actually hoping the stock price will go down below how much?
135.
135, right? Yeah, they're hoping the stock price will go down below 135 because then the payoff to that put option becomes positive. However, the profit to that buying that put option will not become positive until it drops another 13/16, which was the initial premium amount. Let's see here. What about so the last one? The stock price is still 138 1/4. The strike price is 140. Let's use the terms in the money and out of the money. Is the call option in the money? No, because the stock price is below the strike price. Remember, call options, you want the stock price to be higher than the exercise price. Okay, so that means this thing, the intrinsic value of it is how much for the call? Zero, right? And yet the darn thing is selling for how much?
600.
$6.50. How much of that is speculative value?
600.
Yeah, all of it, right? Now, from a perspective of a put option, is this thing in the money or out of the money? It's in the money. And we could see that 140 minus 38 1/4, I believe that's $1.75. And yet this thing's selling for 7.5. How much is my speculative value? How much?
570.
Yeah, like 575, I think, right? All we have to do is take that $1.75, subtract it from 7.5. If it were 7 3/4, it would be 5 3/4. But it's, if it were, it would be 5 3/4. But it's not, so we have to back it off another quarter. So that's how you figure out these intrinsic values. By the way, would you get the right answer if you used your calculator? Absolutely. I know Mr. Ali is an expert with the calculator. Right?
Yeah.
Okay. So, why does this one have such a high price compared to, say, January? And the answer, so the fact that we don't have 140s, why do you think that the 140 August has a higher value than a 140 July? Is it the difference in the intrinsic value or in the speculative value? It's got to be the speculative value, right? Because the intrinsic value for these are identical. And so that's one of the things we're going to see when you price options is the longer the time to maturity, the more valuable it is. Why? Because you've got more time for that stock that's underlying your call option to take off, right? Or you've got more time for that company underlying your put option to go. Does that make sense? Okay. Now, this gets back to something you asked last time, and that is, what's better, to exercise it now or to sell it now? If I want to get out from under this, what's better, exercise or sell it? If I exercise, let's see, if I exercise the first one that we talked about, I would get $3.25. If instead of exercising it, I sell it, I get $4.75. Which would you rather do?
I'm sorry, say one more time.
Okay.
Which one?
You ask.
Which one are you talking? The
You-
one that you buy?
Yeah, the one that's all in red.
Okay.
Okay.
Uh-huh.
If I just exercise that, I get $3.25.
Yes.
Okay.
So,
But what if I sell it? I get how much?
130 quarter, are you talking about?
No, we're not selling the stock.
Uh-huh.
We're talking about the option. If I exercise the option,
Uh-huh.
and the stock price is 138 and a quarter. My payoff from that is 138 and a quarter minus 135, or $3.25. But what would I get if I sold that same option?
Selling the option,
Uh-huh.
just the premium.
Yeah.
It would be just the premium.
Yeah. How much? You're almost there.
4.75.
Yay! Now, my question to you is this, and I think I know the answer. Which would you rather have? $3.25 or $4.75? And that's why we say, and we have to throw in this deal about there's some weirdness with dividends, but assuming it's a stock with no dividends, it's never optimal to exercise an option early. Let me say that again. It's never optimal to exercise an option early because you're just giving up that speculative value. It's never optimal to exercise an option early because you're giving up the speculative value. The same reason you don't accept a job offer early. Something could happen in the meantime that would make life even better, right? And so you don't want to go ahead and exercise that option. You don't want to exercise these options. Better to sell these options than to exercise them because then you can capture the speculative value. Does that make sense? Yeah. She seems unconvinced. Okay, let's do another one. Go ahead.
So 138 quarter, right? It's the stock price.
Yeah,
And
138.
I have a 135 call option,
Right.
but I paid for the premium to get that. How much did I pay for that?
It
It's
doesn't,
not there.
doesn't matter. And here's why. Because the profit is going to be the payoff minus the premium. What you paid in either situation is exactly the same. But by selling the stock, selling the option instead of exercising it, your payoff is $1.50 higher. So your profit's going to be $1.50 higher, regardless of how much you spent for it.
Okay.
So let's assume that you spent $2 on this thing.
Okay. So my profit would be 125 then.
If you
that,
exercised
it. And on the, if I sell it, 375 minus 2.
275. Yeah.
Oh, okay.
Does that make
Not
sense?
good. Huh?
Yeah.
So we could-
And so it really doesn't matter how much you pay for it, the profit will always be higher.
Oh, okay. Now I got it.
Very good. So the rest of you understand, or are you just so confused that you're trying not to think about it? Mr. Ali, are you confused?
I'm confused.
Okay, here's what you need to know, Mr. Ali. Is it ever optimal to exercise an option early?
No.
No.
Put there.
No, you don't. Hopefully I've made that point to you quite clearly, right? And the reason it's not optimal is because you give up the speculative value. If you exercise it, you only get the intrinsic value. If you sell it, you get the intrinsic value plus the speculative value. Let me say that one more time. If you exercise an option, you only get the intrinsic value. But if you sell the option, you get the intrinsic value plus the speculative value. And if this thing hasn't expired yet, the speculative value is always positive. Because there's still a chance things could happen and make this pay off for whoever was buying the option. And so that's why we say it's never optimal to exercise an option early because you're going to lose out on that speculative value. Does that make sense?
Is the intrinsic value the same thing as a payoff?
Yes. Oh, yes. Yeah. Very good. And and we looked at that formula for like the call option is equal to the stock price minus the exercise price or zero, whichever is greater. You can think of that as the intrinsic value. And in fact, if we go back and look, you see that we've actually got that listed as the intrinsic value. And you're absolutely right, that's the payoff. No, sorry. It's not the payoff, it's the premium, right? So the intrinsic, so the premium on the last day this thing is alive would be the maximum of stock price minus the exercise price, or 0. And anything over and above that would be speculative value. And so basically, the speculative value is anything over and above what the premium would be if it were on its last day of its life. Intrinsic value. So the payoff is not the same as the intrinsic value. And here's why. When I exercise, sorry, let's go back. I think maybe you're actually right. Yeah, you're right. Sorry to confuse you.
It is the same?
Yeah.
Okay.
And here's why. Take a look at this. Let's look at call options. It's easier to think about. That formula, maximum of stock price minus exercise price. It gives us 0 up until we hit 50, and then it starts to go up by $1 for every. So the payoff is the same as the intrinsic value. Sorry about that. Occasionally, I glitch. Okay, questions?
So you said that it's 135 is the strike price and it's the stock is at 138. So if we exercise it at 135, we will benefit from like $3, right?
Yeah, if you've got the call option.
Yes, but I don't know. I just wrote this in the previous slide that if stock price goes more than from this graph, like the 50, you lose money. So if it's more.
Okay, so we're talking the difference between buying the option and selling the option. You see how it says sell a call right there on that line?
Yeah.
Now write sell really big on that graph. Sell.
Oh.
Yeah. And then go back and look at the previous ones. So for instance, this one here, that's sell a put. So if you go back further, you'll see buy. So we started off with talking about buying or holding the options, and then we moved on to selling or writing the options. And remember that the payoffs for those things are exactly the opposite. Yeah. Good question. Other questions? Okay. Whew. Yeah, options are never easy. Okay, now we're going to move on to something called put-call parity. And there's an equation at the top of the slide. Let's walk through everything in that equation. P sub 0 is the premium on a put option today. P sub 0 is a premium on a put option today. S sub 0 is the stock price today. S sub 0 is the stock price today. C sub 0 is the value of, is the premium on a call option today. C sub 0 is the premium on a call option today. Now, that put and call must have the same terms. In other words, they've got the same date of expiry. They've got the same exercise price. They have to, in order for this relationship to be true. So we could be talking about a put option with a $30 exercise price for November, and we could be talking about a call option with a $30 exercise price for November. They have to be the same. And then we've got plus E. What do you think E stands for? Yeah, it's the exercise price. And by the way, it has to be the same exercise price as C sub 0 and P sub 0. So all these three things have to match up. And then R here on the bottom is the risk-free rate. R here on the bottom is the risk-free rate. And T is the time to expiry. T is the time to expiry, expiration, or expiry, depending on how you want to say it. Now, that T has to be the same as the amount of time left for the call option and the put option. It's all the same. Okay. Now, here's what we're really doing with this formula. Down here at the bottom it says, consider the payoffs from holding a portfolio consisting of a call with a strike price of $25 and a bond with a future value of $25. So we're looking first on that right-hand side. The right-hand side says C sub 0 and plus the exercise price. We're going to buy a bond with the face value that's the same as the exercise price. By the way, can you actually go out and do this? No. Unless you've got an exercise price of 1,000, right? It would be really rare. This is an exercise to get us to understand why this formula works the way it does. Now, notice that the green here, that's the payoff to the call. The payoff to the call, we got a strike price of $25 here. The payoff to the call is 0 below 25, and above 25 it goes up $1 for every dollar the stock price goes up. We've already talked about that. Now, the value of the bond, and by the way, this is at expiry, the value of that bond is going to be exactly E at the end. And it's not dependent on stock price. So no matter what that stock price ends up being, that bond's going to be worth exactly $25, right? And so if I add those two curves together, basically I'm just shifting that call payoff up by $25. And it gives me that red line there. So that would be the payoff of that, or the portfolio value today based on the stock price. Once again, the bond doesn't change value based on the stock price, but that call option value does. Okay, now that's the right-hand side. What happens if we look at the left-hand side? We have, we're going to buy a put option, and we're going to buy the share of stock. And buying a put option is like buying insurance against the stock price falling below the exercise price. And so when the stock price, when I'm coming down this way, the payoff of a put option is 0. And then once I hit that exercise price going down, now for every dollar that the stock goes down, the put option goes up $1. But what's happening to the value of that share of stock that you bought at the same time? By the way, the share of stock is a green line. You only see part of it. What we see is that as that stock value goes down by $1, the value of your share goes down by $1. It makes perfect sense. But for this portion down below 25, when you are gaining $1 on one thing and losing $1 on the other, what do you get? 0, right? And so we see that when we add these two things together, we get this portfolio payoff. We know this portfolio is going to be at least $25. Remember, we said that the put option is actually insurance for this share of stock falling below the exercise price. So we know we're never going to go lower than $25 on this deal. But if it is higher than 25, then I get $1 for every dollar it goes above that. Now, this is a way to protect yourself from downside risk while leaving yourself open to upside risk. And all it's going to cost you is the value of the put option premium. Does that make sense? Okay, so when I buy insurance for my car, what am I doing? I'm limiting my losses, right? It's the same here. When you buy a put option on the stock, you're limiting. You're never going to fall down below $25 on that investment. If you bought it for $30, you'll be losing $5 a share on your payoff, and then you'll also have that premium in there. But it's an insurance policy. By the way, the insurance premium, I pay it over and over and over again, and I very seldom collect, right? And it may be the same here. People may be protecting their portfolios from, right? And so they may very seldom exercise the put option. Now, what happens if the whole market takes a dump? Pretty much all the put options get exercised. Does that make sense? And why would that be like the worst possible day of your life for that to happen if you were the one that wrote the put option? Yeah, you're in a world of hurt as it is, right? Okay, now let's see. If I look at this, by the way, this is P sub 0 plus S sub 0. If I look at this curve and I look at this curve, what do you notice about them? The red curves. What do you notice about them? They're exactly the same. And that's why we can say P sub 0 plus S sub 0 is equal to C sub 0 plus E divided by 1 plus R, divided by 1 plus R to the T. Now, let's talk about why it's E divided by 1 plus R to the T. And someone said it a minute ago. What does that actually represent?
Closer to maturity date.
Oh, okay. So as we get closer to the maturity date, T gets smaller. But that formula that we used out here on the very end, E divided by 1 plus R to the T, what does that look like? It's present value. It's the present value formula. And so what we're really saying here is that the call on a premium plus the stock price is equal to the call premium. So the put premium plus the stock price is equal to the call premium plus the present value of the strike price. That's the present value of the strike price out there on the end. Now, something I want to point out to you is that you will see two different ways to go about this. This is the one that we currently have on our slide. And you may also see this. E to the, no, E times negative E, sorry. It looks like that. Oh my goodness. What is this thing?
Yeah.
2.718 blah blah. It's called the exponential, right? And the reason we're doing that is because of continuous compounding. The reason we're doing that is because of continuous compounding. And if you look back at continuous compounding, we said that future value is equal to present value times e to the negative RT. And the way I remember that is, to me, that looks like the word pervert. You know, whatever, trigger. It's actually not equal, it's not negative. It's not negative, sorry about that. Now, if I then calculate present value, which I said we're trying to do here, just like this, present value is equal to future value divided by e to the RT. And it turns out that if we put a negative in there, it's future value times e to the negative RT. That means exactly the same thing. It means exactly the same thing. So e to the negative RT is actually 1 over e to the positive RT. Whew. Are you wishing you paid more attention in algebra now? Maybe so. Okay, so do you really need to know all that? Well, one of the things, so listen, one thing you do need to know is what's the future value of this thing? When we were doing bonds, what did we put the face value in as? Future value, right? The face value is always, we put in as future value. So that's what's going on here. And the face value of that bond is the same as the exercise price. And so that's why we have E times E to the negative RT. Now, here's the trick. If you're doing the practice problems and they say continuous compounding, if you use this formula instead, your answer will be off by a few pennies. And because you have to type it in and it has to be exact, you'll get it wrong. However, if you use this, you'll get it right. On the other hand, if they're not talking about continuous compounding, it could be the other way around. Now, on an exam, what would I do, or homework, what would I do if I were you? I would use this formula because it's a whole lot easier for most people to deal with, and the answer is going to be a few cents off. What do you do then? Yeah, you look at the choices and you see the one that's like 3 to 5 cents off. That's the one that you pick. Does that make sense? By the way, all my exams say choose the best or closest answer, right? Questions? Do you think that I might ask you, I might give you the put, the call, the exercise price, and the expiration date, and the risk-free rate, and ask you to figure the stock price? Yeah. Do you think I might give you all the information except for the call premium and ask you to figure the call premium? Yeah. Do you think that I might give you all this information and ask you to figure R? I don't think so. That would be kind of cruel, right? That would be a little cruel. And I might not ask you to do T. But definitely would I ask you to figure exercise price, call premium, stock price, or put? Yeah, sure. Can you get them? Just with a little algebraic manipulation? Not a problem, right? Questions? Okay, now we're going to talk about valuing options. We've been talking mostly about intrinsic value here. We haven't talked about how we're going to calculate that speculative value. This has all been at expiry so far. But what if it's before expiry? Well, we know that the premium is going to be higher than the payoff simply because of the speculative value. We also know that the closer we get, well, we'll leave that for now. Okay, now the value of the call option, we know it has to be between the current stock price minus the exercise price. That's the lower bound, or 0. It's got to be the max of stock price minus exercise price, or 0. And then that call option, it also has to be worth less than the stock price. Now, why does the call option have to be less than the stock price? If the stock were selling for less than the call option, what would you do? Would you buy a call option on it? No, you'd buy the stock, right? Yeah, you just go out and buy the stock. If that stock price is less than the call option price, you just go out and buy the stock. So that's why we know that the actual price out there in the wild is going to be bounded by those two things. And we can see that red value, that red curve there is the market value, and the green is the intrinsic value. And the difference between that market value and the intrinsic value is the speculative value. Earlier, we called that market value, we called it the premium. That's the market value of the premium. It's what it's trading at today. Questions? So, how do we come up with this? Well, it turns out that back in 1973, two finance or economics guys named Myron Black, someone Schultz, or Myron Schultz, anyway, Fisher Black and Myron Schultz, they come up with this model. Before then, no one knew how to precisely value options. But they came up with this model. S is the stock price, and then a D1 is figured as given below. Now, you'll probably recognize things like S and E, stock price, exercise price. You probably recognize T, the time left to expiry. And now, notice we've got sigma and sigma squared. What do you think those things represent?
Variation.
Yeah, so the variance is sigma squared and standard deviation is sigma. Those, the standard deviation and variance of the returns on the underlying asset. Standard deviation and variance of the returns on the underlying asset. And let's see, so then what do you do with those numbers once you calculate them? Well, those are z values that you throw into the normal distribution, and that's going to give you that ND1 and ND2, the values you get out of that normal distribution. You multiply it by the stock price on the left-hand side, and then over here it's the present value, you subtract present value of the exercise price. Anyway, long story short, am I going to ask you to do this on an exam? No.
That's very cool.
The majority of people can make it through their entire lives and not have to do one of these calculations. you, as a finance professional in corporate finance for sure, will not need to know how to do this. And by the way, do you think there are spreadsheets out there that could do this for you? Yeah, you go out on the web and you could find like 2 or 3 and make sure they all give you the same number, right? And if you do it, you can test them out. You can look at stocks that are currently out there and you can put them in there and you figure out, are they right or are they wrong? Now, why then am I trotting this out in front of you? Number one, it's history. If it hadn't have been for the Black-Scholes model, by the way, the Black-Scholes model comes out in 1973. When do you think they started trading options in Chicago? 1973, because before then, no one knew whether they were getting ripped off or not, right? But now we have this formula, boom, it's amazing. It all just happened like that. Now, the second reason I tell you about the Black-Scholes is because it tells us what happens when things go up and down. So, number one, let's talk about what happens when the stock price goes up. If a stock price goes up, the call premium will be higher, right? If a stock price goes up, the call premium will be higher. If the stock price goes up, what happens to the put premium? Goes down, right? Okay, so we got that one in the back. Exercise price, absolutely the opposite, right? If exercise price goes up, call value goes down, but it's more likely the put option's in the money, therefore put option goes up, call goes down. Interest rate. For a call, and we could recalculate this, if you look at call is equal to this plus this minus that. As the interest rate goes up on a call, we can see that the value of the call goes up, but it goes down for put. And it all comes down to which side of that equation we're on. Remember, because put and call are on the opposite side. So in one case it's going to be negative, the other is going to be positive. Then there's the volatility in the stock price. That's that variance or standard deviation. And it turns out that the greater the volatility in the stock price, the greater the value is for either one of these things. And here's why. Which is more likely for something to get to the, let's just look at the call. Which is more likely for something to get to the exercise price? This dog or this dog? Yeah, the groovier one, the one with more volatility, is more likely to break through that exercise price. And it's the same on a put. Which one's more likely to get down to the exercise price? This one or this one? Right? Oh yeah, the big one, right? And so that's why the higher the volatility, the higher the value of the option always. And then the expiration date. The further out in time, the more valuable both of these are, because there's more time for either the stock price to rise above the exercise price for a call, or the stock price to fall below the exercise price for a put. Does that make sense? Now, what should you have on your note sheet? Whoop, right there, right? 1, 2, 3, 4, 5, call, put, plus, minus. That's what you should have. Now, next time, we're going to talk about how these options inform our thinking about corporate finance, and hopefully we'll get to start on some example problems. So go ahead and bring your list of example problems that you want to work. Questions? See you next time.